Hi, everyone. Welcome to Friday. As always, I'm looking forward to today and excited to be able to talk about some things that are going on. Excited to see everybody here. Hopefully, we even get a few more coming in as we get things rolling. Really quickly, before we jump into our daily discussion, a couple of simple housekeeping items. First, if you want to interact with me or with the group today during the session, you can use the chat window over on the right-hand side. Just go ahead and drop a comment. I'll be watching that throughout the course of the session, and we'll try to incorporate questions, comments that you have into our discussion today. So it's an easy way that you can interact with me and with the session. Also, depending on the platform that you have joined Rebel Income on, there's a couple of different ways you can send me questions, comments, or interact with the community that I've tried to provide for you. If you are on Discord, the first thing that I want to encourage you to use is the open discussion forum. This is an area where you can post comments for anybody in the group to respond to. I do pay attention to this, and so if you want to reach out directly to me, you absolutely can do that. You can also send direct messages just by going to direct messages and excuse me, looking for me on the left-hand side of the panel, and then you can send me a message directly that way. If you are on Substack, let me switch over to here we go. If you're on Substack, you have the same ability to chat with me or with anybody here. You can just go ahead and go to Rebel Income, and this is a thread that I've invited everybody that is on Substack to use. Again, I pay attention to these threads throughout the course of the day, try to respond as soon as I can. Want to encourage you to go ahead and use that. Barry, thank you very much. So far, so good as the webinar goes. Hopefully that holds. Last week we had some technical problems, and I'm hopeful that those will be a thing of the past, and that we'll have just a regular, normal operation. So please, if you do encounter any technical problems, feel free to drop that in the chat and let me know. Okay. So that's enough of the housekeeping stuff. Let's go ahead and dive in and start talking about what's happening in the markets. It's interesting to see. Well, at least for me anyway, it's always interesting to watch, the market from day to day and see how it responds to different criteria, different inputs and influences, different news events, etc. Over the past week, after a lot of volatility on the downside, on the bearish side, because of tariff fears and everything related to what people are afraid of about those, it looks like the market has been trying to recover some bullish momentum. Some of that certainly comes from speculation and news that maybe those tariffs are going to be a little bit easier than everybody had thought, that there's a lot of countries coming to the table to negotiate with the U.S. And so that's stoking some enthusiasm. Hello, Jay. How are you doing? So glad you're here. So that's stoking a little bit of bullish momentum here that has been giving a lift to a lot of stocks throughout the course of the week. That's a healthy thing. We'll see if that continues. But it's certainly something that I expect is going to continue to contribute to volatility. Whether that's bullish or bearish is anybody's guess. But as we know, the administration loves news. And when I say the administration, I mean Trump. He loves to be on the news. He loves to be heard. And sometimes that's a positive thing, and sometimes it's a little bit worrisome, depending on where you lean. The markets, that's one of the reasons that the market has been as volatile as it has is because of that reality. And I think that we just need to get used to it again. It was something that felt like a pretty common theme in the marketplace with in the first administration up through 2020. And I think we just have to be used to the fact that it's going to continue to be the case now. Okay, talking about current positions, and there's going to be we're going to have a lot of time, I think, to go over a lot of information in the market today. If there are some stocks that some of you are looking at and paying attention to that maybe we don't talk about, expect we'll have some time to go over those and maybe answer some questions, maybe even run through a sample analysis. It's interesting that one last week was a day after the market closed because of the Easter holiday. And so I had a bunch of positions that expired on last Thursday. And as a result of that, having a lot of those clear out, a couple of assignments from General Mills and FCX, of course, a lot of those cleared out. That means that in terms of open put selling or covered call trades, there's really only 3 to talk about. I'll be able to look at some of the recent assignments though and see where things stand, where those stocks sit now, and how that might relate to some of the opportunities that we may have in the market coming up. And then, like I said, if you have some stocks you'd like to look at, I expect we'll have some time for that too. So let's go ahead and start here. We'll just go down to both of my put sales expire at the same time, 3rd week of May. That's just kind of the way things are landing right now. The first one we'll start with was last week's put sale on Conagra Brands, CAG. I sold the $25 strike price, brought in about 3%. This is a 1-month trade. Sold about 2 contracts. So 200 shares there. That means at 25, my total reserve requirement is $5,000. And I'm pointing that out right now early on because I want to make sure to emphasize one of the things we have to be careful about in any market condition is the idea of going all in and getting a little bit ahead of ourselves in terms of enthusiasm. It's really tempting when we're generating income using put sales or covered calls to try to work with as much as we can. If I can get 3% for 1 month, for example, on a put sale, which is way above my normal target of 1.5%, I might be tempted to try to get as much income coming in on that as I can. And that's something that we want to be really, really careful about. Instead of 2 contracts, maybe I do 4 or 6, something like that. Go for a much larger position than what I actually have. That can be really dangerous. And I want to go back to the chart for the S&P 500 right now. Even with the momentum that we're seeing right now, we still have all of that working against the context of a downward trend that began in February and saw the market actually touch bear market levels. Now, this doesn't mean that we're in a bear market. It's been lifting up above that point, and it could sustain that momentum or simply consolidate a little bit above this and still stay up in this area where we're in correction territory. We could stay there for a little while, and that's okay. I wouldn't mind some stabilization here, speaking for myself. But we need to understand that the idea that we're just going to rebound and rally back towards these highs that we saw in February, if that happens, it's going to take some time, and it's probably more likely, given the way that the short term and the intermediate trends have turned negative. This is my 50-day moving average, which I use for the intermediate trend. The yellow one here, this is my 20-day moving average. And then more interestingly is my blue 200-day moving average, which I use as a indicator of the long-term trend. That has started to bend and started to slope downward ever so slightly. So there's a lot more bearish momentum and strength behind the market right now that could mute how much upside we see in the market in the very, very near term. Now, again, this is not a categorically bearish forecast, nor is it bullish. This is just saying that the market has some work to do in order to overcome the momentum that these trends impose. So we'll see what happens. In the meantime, the reason I said that I wouldn't mind a little bit of stabilization right now is that stabilization, consolidation of prices is actually really, really good for income generation. It creates a lot of opportunities to set up some really nice put selling trades. And on stocks that you own, you usually get repeated opportunities with covered calls in those kind of conditions. So we'll see if any of that materializes, of course. But that's kind of the temperature of the market that I'm seeing right now. It's interesting. Before I jumped on this session, I was watching a little bit of market commentary and watching an analyst who was talking about tariffs, talking about the broad market and the way that it has reacted so far, pointing out, and I'm not going to get political here, but just point out that tariffs, when all is said and done, for all of the other rhetoric there is around them, tariffs are a tax. They're a tax on imports. Taxes generally are something that we don't like. This analyst pointed out that the thing that to remember about all of this is you have to take it in a much broader context. And that context is not necessarily about tariffs themselves, but about everything that this Trump administration is doing about taxes. They're working to reduce a lot of taxes in terms of income taxes, excuse me, a lot of other things to try to facilitate uh, business growth as well as put more money in the pockets of American citizens. Those from an economic standpoint are generally a positive thing. So what you have is a consideration and evaluation of the balance of the taxes that are being cut on one side and the taxes that are being increased, tariffs, on the other side. And what is the net result of those? And again, that's a little bit of a political question that I'm not going to get into, but those are that does change the thinking a little bit about how you look at tariffs and try to put that activity in context. Okay, Barry, for the last little bit, my strongest holdings have been Walmart, which has been interesting because Target has been moving in the opposite direction from Walmart, but so be it. Walmart, Verizon, and Verizon and AT&T, those are really interesting to me. Um, I've said this before. These are stocks that a lot of people look at. Here's a chart for AT&T right now, which is kind of which is really held up a lot better under current market conditions than most other stocks, primarily because anything that they have had in the past that would have exposed them to tariff risk is pretty much gone. They're U.S. only company, um, and their stock has been very, very resilient. They also have a lot of fundamentals working in their favor right now, and have had for a while. And so a lot of people, along with AT&T, here's Verizon that has been also not quite as volatile. It's down a little bit more, but still holding between about 42, 45 right now. That's Again, consolidation, right? Which is not a terrible thing. Interesting thing I'm seeing, I see this commentary from telecommunication companies or about telecommunication companies like Verizon and AT&T every so often that compares them to an equity bond. Why? Because they pay a really healthy dividend. Here's Verizon paying 6.27%. And it's not just the dividend yield in and of itself that makes them call it that. It's the overall health of their underlying businesses and the relative stability that has created for their stocks. So here's AT&T and their dividend, a little bit lower than Verizon, but still 4%, which is really attractive. EPD is the other one. He said they seem to have weathered the storm and stayed pretty strong. EPD, another one there that is pretty sheltered from questions about tariffs because these guys just provide they provide energy infrastructure in the U.S. Plain and simple. They're not necessarily involved in import or export. They're just about transporting and facilitating storage of energy products within the U.S. And so, yes, they have been. They did see some early volatility here, right? Just like everybody else, but they've stabilized pretty nicely. And for what it's worth, analysts keep increasing the target price for AT&T. I'm not so sure that I necessarily agree with that. I have not done I haven't done a new round of analysis on this. Their earnings report just came out on Wednesday, and so I've got to let some of that data filter through to my data sources before I do. I'm not sure I'm ready to upgrade to increase the fair value target that I've got for them, but we'll see. Verizon is still very attractive too. So those are all some interesting stocks. Okay, let's talk about Conagra. As I mentioned, this is the an open put sale. I sold the $25 strike price. Yeah, Barry, most analysts have it around 30. And maybe. We'll see. Most analysts are also trying to predict the near term, which, okay, you want to do that, go ahead, have fun. My approach is a little bit different. Conagra then is, we can see it at 24.47 right now. We're still 2 weeks away from expiration on this, and my strike price is at 25. So we're a little bit below that point right now. So we're a little bit underwater. Now, this is a good opportunity. I like this because this means that we can take a look and think about different ways to manage the trade. Barry, I'm in at you're in at 1750, so you're good right now either way. You went with a much more conservative, or if you're talking about AT&T. If you're in at 1750 on Conagra, then you've got a much more conservative position than I do. Okay, AT&T. All right. Yep. Yeah, you are good either way. It's showing some nice strength there for you, to be sure. So, all right, Conagra. This is I went out to May to the May week 3 options for my put sale, not because there were a lack of weekly options, just because there actually wasn't a lot of activity going on with the options that weren't that didn't fall on the regular monthly expiration. So working with the $25 strike price. Now remember, for perspective here, On my put sale, I brought in 75 cents. So that's the premium that I've brought in. And I want to talk about for a minute thinking about how to manage a position when it's underwater. And by underwater, I'm not saying that a assignment is pending. Okay, Barry, you have a closer expiration than I do. You're 7 days from expiration, so you're right here. This is your contract. Thank you. I appreciate that comment. That makes this question even more relevant, doesn't it? Do you want or need to manage the position a little more actively than normal? My method, my approach, and my preference is really simple. I sell the put option. I find the strike price and the premium that I'm looking to bring in, and then I let the result be the result. If I get assigned, that's because I'm selling a strike price that I'm comfortable owning the stock at. If excuse me, if the stock rallies and pushes above that price and expires, and that's okay too. But I work with it either way. I don't avoid the assignments because I want to be able to have opportunities to generate additional income with covered calls once I do own the stock. And so I don't mind those. It's another one of the reasons that I am purposely very conservative about the size of the positions that I take on. All right. Barry, you brought in 50 cents on this at the $25 strike price. So that's not only 50 cents, right? Because this is literally 2% that you brought in for about a 2-week time frame, right? That's actually pretty nice. In fact, that's very nice. 2 weeks, 2%. Your annualized average is a lot higher. And again, here's one of the your I'm well, actually, thank you. You said not compared to my 75, but here's what this is one of the comparisons I love making between what you're going to see me do with my trades and what I like to see happen when you figure out some things that you want to do on your own. Okay, 2%. If you're talking about every 2 weeks, you're working with a shorter time period. You're exactly right. And that gives you the advantage of time. And what I mean is that with selling shorter periods of time, you're able to place more trades. You increase your trading frequency. So if you can do a trade every 2 weeks, 365 divided by 14. These are days, right? That means you have an opportunity to place as many as 26 trades. This is just talking. Obviously, there's going to be some variances here because sometimes you'll sell more time, sometimes you'll sell less. So this is a simplified analysis to kind of show you the overall net effect that you may be able to achieve. So 26 trades times 2%. I mean that should be pretty easy math, right? I'll do 0.02 just so that it looks official. And that's a 52% return on an annualized basis. That's pretty nice. Now, what about me? I brought in 0.75 cents, so my premium was 50% larger than Barry's. That sounds pretty awesome, right? But I also have a 30-day trade. So 365 divided by 30. Yeah, exactly, Barry. This is why I love put selling. This is why I love working with the stocks that I do. Everybody talks about stuff like food products as being boring. Well, yeah, 52% doesn't sound boring to me at all. So I have an opportunity to place 12 trades compared to Barry's 26. So I do 3%, 12 times 0.03, and 36% is my opportunity. Now, 36% is more than adequate, so I am very comfortable with this trade. But by taking advantage of time and selling less time, Barry is increasing the trading frequency to a point where the overall result can be, potential result, I should say, it can be a lot higher, and that's an advantage. That's one of the things everybody is always talking about. How do I try to find an advantage in the market? It's not actually that hard. When I talk about low-hanging fruit on the market, this is how you find it. This is where it is. Take the suggestion, recommendation, whatever you want to call it, of somebody like me, where I'm just telling you what trade I'm looking to place. Check it out for yourself and see if there's some other variations that work for you. And if you do, you're going to have you've got an opportunity to set up your own advantage. And that's very cool. Okay. So with that said, if Barry wanted to manage his trade a little bit more aggressively right now, just in a little bit of time it's taken for me to run these comparative numbers, we've seen the numbers shift a little bit for the put sale. Barry's contract, you'd have to, if you wanted to buy this back, if you were trying to avoid an assignment and you were worried that now that the stock is down here at starting to push down towards 24, maybe you don't want to take that assignment, you're going to eat a loss of about 60 cents per share on this right now. Now, this is not a recommendation, obviously. Barry, you're going to do what you're going to do, I know. And that's perfectly fine. That's awesome, in fact. But that puts it into a different kind of context. For me, again, remembering I brought in 75 cents. If I wanted to manage that right now, I would have, if I wanted to close this out and eliminate the possibility of being assigned, and these are American style options. So as soon as a stock drops below the strike price that you've assigned, that you have sold, that means you can be assigned. Not necessarily that you will, and I haven't been yet. A lot of whether or not you will be assigned depends on how far the stock has moved below the strike price that you've sold. And Conagra is not so far away from mine or Barry's to make that a really big concern yet. But if I did want to try to avoid that assignment, I would have to pay $1.25. So I would eat a loss of about 50 cents per share. Since I sold 2 contracts, that would be about $100 I'd have to be willing to give back to the market. Now, I've just said previously that my intention is to hold this and let the result be the result. If I get assigned, so be it. That is not necessarily about trying to avoid the idea of taking a $100 loss here. In fact, a lot of people in our group who do take this more active management approach and are trying to leverage trading frequency not only by selling shorter time periods, but also by managing trades more actively and purposefully buying contracts back before expiration. When the stock puts them underwater, they'll move very quickly to limit that loss. That's smart. Again, it's not a recommendation that I'm making. However, if your preference is to be a little bit more active about managing each position, then taking advantage of the opportunity to limit that loss is an advantage. And if you look at some of the stocks that I have been assigned, that's going to be useful for what I'm talking about here. Just for perspective here, let's take a look at FCX, which I was assigned at 40. It's rallied a bit, but it had dropped all the way down to 28 before I was assigned, and now it's still about $2.50 away from the price that I was assigned at. How about General Mills? I was assigned that one at 60. Okay, Barry. So you that Pilgrim's Pride trade was really interesting. The reason the big drop in strike price on PPC was due to the 630 special dividend. Yeah. Okay. You bought it back and resold for the 58.70 strike price. That's good. So I sold GIS. I own it, I should say, at $60. So here's the strike price that I was assigned at, and the stock is picking up bearish momentum, dropping below 56. Okay. So I'm down not quite 10% on this, but this is a good example. This is one where, excuse me, I'm down about $400 on paper. I haven't sold the stock, and so it's not a realized loss. But literally speaking, I'm about $400 underwater on this position right now. If you're taking this more active management approach and you're limiting the loss to $100 versus 400 or possibly more, or whatever the number is, then that is a long-term net positive thing. It's going to help to make your positive trades more impactful. In my case, it means that this doesn't really scare me too much, but it does mean that I have to be willing to be more patient. I have to be willing to let stocks ride through the ebbs and flows that they're inevitably going to follow. Sometimes that means holding through extended downward trends. The point of whether or not you're willing to do that, and where I'm willing to do that, really boils down to my view of the stock, the company, the fundamental analysis that I've done, as well as the value proposition that I see in the stock. I think the value proposition for General Mills is well above 60. So if I like it at 60, then I'm not afraid of the stock at 56 too much either, especially if I think the upside is much higher. That's what gives me that patience, as well as a dividend that doesn't always have to be huge, just has to be functional. And General Mills has a functional dividend. So that's what makes it. So that's how that evaluation works. So what should you do with CAG if you're into it? If you're in it like I am, well, that depends on what your preference is. As I've said, I'm willing to let this play out to the third week of the third Friday of May and see whether or not I am assigned. Still about excuse me. Still about 3 weeks to expiration on this. So there's time. There's time to see the stock stabilize and move back higher again. Whether or not it does, of course, that's an open question. So we'll see. Okay. Let's take a look at the other put sale, which is on Levi. Here's our stock. Sitting at around 1586 right now. And I sold the $14 strike price. Brought in not quite 3% for a 3-week trade on this one. So obviously I'm in a pretty nice position on this one right now. Brought in 40 cents. That was just a couple of days ago. I wouldn't expect to see a big difference right now on that contract. This is a stock that does not offer weekly options. So the interesting thing on this is that the move has been positive enough at the $14 strike right now, if I wanted to buy it back, asking price is half of what I brought in when I sold the contract. No volume right now, but enough open interest. If I were to put a buy to close on this at 20 cents, it would get filled. Again, talking about active management. This is a situation where, and again, not everybody's going to do this, right? But here's what the opportunity is. I'm generating 2.86% return for a 23-day trade. Okay, I like that. But to put this into an annualized perspective, 365 divided by 23, so that's 15 trades. If I can repeat that again and again and again, then that's an average about 43% per year, which is nice. A lot of the people that I've worked with that like to use put selling on a more active basis, they'll talk about rolling. Rolling means if the number one, if the stock is kind of like Conagra right now, a little bit underwater, you'll buy back very quickly to minimize loss or the potential for loss. It also means that you'll look pretty actively about buying contracts back when you get a positive move in your favor. And for some of the rollers that I know, they will look very seriously at doing that if the premium that they can hang on to when they buy the option back is 50% or more. So right now, this is 50%. So it's hitting that threshold. Again, I'm not saying this is not a recommendation to buy, sell, or do any specific thing. I'm just pointing out what the strategy is. And here's the advantage. If you buy that back, your net result is 20 cents on a $14 strike price, right? So 0.2 divided by 14. Let's see, make sure I did that right. Divided by 0.2 divided by 14. There we go. 1.42%. This is for a trade that I put on Wednesday. That's 3 days. This is not normal, to be clear. But I could buy this back and still realize that 1.42, almost 43% result for 3 days. Get the capital back that I put into the trade, and I sold 3 contracts at 14. So I'm in at about $4,200 is my reserve requirement. If I could recycle that same $4,200 every 3 days in the same way, so keep that in mind, 1.42%. 121 trades. Okay, again, this is unlikely. This is not normal. But there's what that can do. I would not expect that to be a sustainable pattern, but this is why active rollers like rolling so much, is because you do get these opportunities from time to time to do this, keep that 50%, get your capital back, and then decide what you want to do next. With the positive move in the stock at 16, it's pushing above 16 right now. So I could think about whether or not I wanted to sell another contract for another 20 cents at 15. Or maybe even be a little bit aggressive. Here's 55 cents at 16, 21 days to expiration. Barry, I don't always have the time to be that active. Neither do I. I'll be honest. This is one of the reasons I don't do this. But this is what this is a strategy that is available. There are plenty of people in the Rebel Income group that are this active, and this is the opportunity that they're providing themselves, not 121 times on the same stock. Very absolutely full. Most of us do other things besides trading, right? That's okay. That's the way it should be. Trading is part of our lives. It's not necessarily all of our lives. But again, if you have the wherewithal, if you have the time, the desire, if this just fits your trading style better, this is the kind of thing that active trading can provide. So this is an advantage over my more passive approach that I encourage for those who have the desire to follow it. Okay. The only other trade that I have on deck that is set for expiry next week, or excuse me, that is set for expiry is actually coming up on the 2nd of May. So that's actually next week, excuse me. And that's on Barrick Gold. This is a stock I've held for a little bit. I was assigned at $20.50. And a lot of the market's uncertainty has that's what set up that opportunity for the covered call. And we can see right now it's pulled back. It's a little bit above 19 right now. I still really like companies in the mining sector, especially as they relate to precious materials. With the market's latest bullish push notwithstanding, I still see precious metals as a nice way to kind of provide a little bit of a hedge against not necessarily market volatility, but against inflation and some of the market fears that are in place. Tariffs specifically were a positive for a lot of companies in this space. FCX is one of those, for example. Barrick's another one. So we'll see. Again, this is set for expiry next week. It looks like, based on this latest gap, it may not be able to get back all the way up here to 21. It didn't get above it when I sold the covered call. It was just in that neighborhood. So it looks like there's a good chance I may hold the stock a little bit longer. It's got an earnings report coming up first week of May, so a little bit after the position expires. So we'll see. We'll see where this lands in the next week. I'll be a little bit surprised if I get called out of it. Not unhappy. I just don't expect it. So Barrick has been productive, even with these relative swings. You know, here's a move from 21 all the way down to 15. On a $21 stock, $6 difference. That is significant. Then back again. So has been a little bit volatile, but it also pays a productive dividend. 2% of the current stock's current price. Doesn't have to be huge to be productive. Okay. So I already used General Mills and FCX as a way to put in context some of the downside risk that you have to be willing to think about and account for when you're using a put selling strategy. The reality that stocks you are going to take some assignments. Sometimes those come in batches, depending on what the market is doing. Using position sizing to limit your total exposure in those trades is important, but it also means that you have to be willing to think about those downward trends in a little bit different context than most people do. So let's take a look at some of the other stocks that I'm holding right now. We'll start with Skyworks. I was assigned this one at 67.50. Had an opportunity to sell a covered call on this that expired last week as well. So let's take a look at where Skyworks is now. Big drop here. That is actually what created the opportunity for the put sale that I placed here. Was assigned at 67.50. So I'm going to draw a line about here. Here's my assignment level. And April, beginning of the month, really took the stock all the way down to 48. It's showing some strength. It's rebounding pretty nicely since then. But this is a really good example of the kind of thing that you have to be willing to absorb if you are going to do what I do and actively accept assignments. And it all has to boil down to what your view of the company is. A lot of people right now are kind of afraid of tech stocks, especially anything in the semiconductor arena. Anything that may have to do with AI is a little bit volatile right now. There's a lot of fears coming again on the tariff front related to China and what the net effect of those negotiations and discussions are going to be. And technology has kind of taken the brunt of what those fears are. I think that some of those are a little bit overblown. These companies are also pretty active and mostly proactive about analyzing, identifying, and trying to mitigate whatever those risks are. They're aware of things like tariff risks, import risks, because we played this game before. We did it in 2018 and 2019. And there's been a big push over the last 4 or 5 years to increase fabrication and manufacturing capacity of these kinds of products in the US and not have to source them out as well. And I think some of that is being ignored when it comes to stocks in the semiconductor industry, tech stocks in general. Okay. So if these kinds of drops in price do happen, and you have to be willing to try to keep a level head in these cases and try to think about it in that broader context. Am I willing to ride through these periods and let the company's strength play out over time? These guys pay a useful dividend, 4.5% of the stock's current price. But here's an interesting headline. Skyworks lowered its Q2 revenue guidance. Class action lawsuit claims the company misled investors on revenue expectations. So those are things that are working against the stock right now. That's what accounts for this gap. And then tariffs pushed it down into this level. So we'll see. All right, got some time. Pretty much gone over the stocks that I wanted to look at and focus on, and most of the concepts I was looking to discuss. So we can open things up a little bit to some of the stocks that the rest of you may be following. If you want to drop some of those symbols into the chat, happy to take a look at those and talk about them a little bit. Feel free to share your perspectives about them. These may be stocks that you're holding. They may simply be stocks that you're paying attention to. Barry, thank you. Another 8-day trade on NVIDIA. Oh, no, I'm sorry, not NVIDIA. This is the EV. This is the ETF that is tied to NVIDIA. And you've used this, we've looked at this in previous sessions. Another 8-day trade on NVDL brought in a $1.14 premium on a $29 put sale that expires today. And with the stock at 34, that looks really, really nice, right? You did have to, you'd have to deal with a little bit of uncertainty. Here's 1, 2, 3, 4, 5, 6, 7, and 8. So the stock was up here at around 39. When you placed the trade. So you had to watch it drop down all the way to about, what is this, a little bit below 28, maybe 27.50. And then it's rebounded again. But yeah, if that's expiring today, you brought in that $1.14 in premium, then Barry gets a great big tick mark. Yeah, it's around 30-ish. Okay. Around 30-ish, and it's working out, right? Sitting at 34 now, you've got some nice momentum there. So good result. That is very nice. And this is an ETF that offers an interesting contrast to working with NVIDIA directly. The stock at 107, the pattern is similar, right? But the prices are different. And NVIDIA at 107 may not be accessible or practical, and depending on the size of your account. And if it isn't, then NVDL gives you an alternative to work with. Now, there's a caveat here. One of the things about NVIDIA is they do pay a dividend. It's not huge. In fact, it's pretty negligible. But working with NVIDIA directly does give you the opportunity to bring in that dividend income as well. And VDL does not. Small distinction right now, given the level of NVIDIA's dividend, I know, but worth pointing out. Not obviously something that you would hold, but it's been fun to play with, sure. And if it's giving you that kind of a result, then that's a nice thing. So that's awesome. Downward trends provide these opportunities. We get into these trends, and everybody wants to treat these stocks as radioactive. But that's where opportunity lies for those of us who are hunting for value. It's why it's kind of what we're talking about is considered to be kind of a contrarian philosophy. Because when everybody else is afraid, that's where we're looking for opportunities to buy. Doesn't mean that doesn't mean that the downside is all gone. But if the fundamentals are solid, if the value proposition implies the stock should be higher, then it makes a little bit more sense to be a contrarian in those cases. So Barry, thanks for sharing that. I appreciate that. Barry, when I've been assigned, I get out of it pretty quickly with a call sale. Yeah, turning around and doing a covered call as soon as possible. That's a good way to generate additional income, right? And hopefully set up an opportunity to get called out if the stock's momentum continues to push higher. So, thank you. All right, any others? Volatility is your friend. Yes. That's the thing. People are afraid of volatility, right? Uncertainty breeds volatility, and all of that sounds really scary. Volatility volatility increases premiums. That means that buying options becomes more expensive. And that's where directional traders really get chewed up when the market is volatile. Because they're paying more for those premiums, and then the market is moving for them, against them, for them, against them, for them, against them, and time is just bleeding away to the point where they have no chance to make up the higher cost of the options that they were working with. So volatility works very much against buying and sell, the traditional buy first method of option trading. No matter whether you're talking about buying, whether you're working bullishly or bearishly, in my opinion, volatility is going to kill that kind of trade, unless you happen to get really lucky and you guess right in a very short period of time. So you'll hit some home runs, but you'll have a lot of losers. On the other hand, where I could get out now for about $2, too cheap to give it up. No, that's okay. Um, Volatility, on the other hand, if it's causing buyers to pay more, that means sellers. That's us. We're getting more in premiums with shorter time periods. If time is working against those buyers, it's working for us. So volatility only increases the advantage, which is awesome. So Barry, thank you for that comment. Volatility is an option seller's friend. That is something that I have a hard time getting people to understand, but I appreciate you bringing it up because it's exactly right. All right, everybody, thank you so much for your time. Really appreciate your participation, and hope this has been useful as always. If you have questions between now and next week, don't hesitate to reach out. You can send me an email at rebelincomesystem@gmail.com. I'll respond to that as soon as I can, or message me, as I mentioned, in whether it's Substack or Discord. Either way, whichever platform you're on, I will see those messages and respond to them as soon as I can. Again, appreciate you so much. I hope you have a wonderful weekend, and we'll talk again next week. Thanks, everyone.